What are accounting adjustments used to reconcile valuation methods? Well, to start with, the valuation methods commonly used for companies diverge oftentimes dramatically from the valuation identified on the books or the book value or even the fair market asset value of the assets of the company. Now, why is that? Well, generally, the way a company keeps track of asset value is based upon principles of accounting. Okay, that the generally accepted accounting principles allows the company to minimize tax burden, defer revenues, things like that, that paint a better picture of the company than may be a reality in many situations. And for this reason, when a company is being purchased, and that's generally the time when you do a valuation, but anytime you're doing a company valuation, you want to reflect the closest or most accurate valuation of the company possible. So to do this, you actually need to make adjustments or normalize, as we say, the financial statements. That is, make adjustments to the accounting just for that valuation purpose. And you wouldn't do this in financial accounting, which is primarily concerned on reporting the actual results of company operations. In managerial accounting, however, the numbers that you create, the reports that you create are for internal use, right? And part of the valuation process is part of the negotiation of value with other companies. And other companies are going to check on this value as part of what we call due diligence. So with that being said, to paint the correct picture of the company, you're going to normalize the financial statements. You're going to address things like, what is the accounting basis for many of your assets? What are your revenue recognition principles? That is when revenue is actually earned or accounted for. And then your inventory costing methods. These are some of the main financial aspects that you're going to address. Now, another thing that you're going to address is anytime you have some obvious economic realities that aren't demonstrated on the financial statements. And that could be any element of poor strategic performance. It could be any divergence in the actual value of the company versus what your tax value is or what you're demonstrating on your financial statements. Okay, next, related party transactions. So you've cleared up the financial issues, that is the money coming in, the money going out. But oftentimes a company will have scenarios where they have sweetheart deals with key individuals that are related to the company. That is, they're underpaying or way overpaying the executives or the board members or something like that, or they've made loans or purchased things that individuals in the company are using for personal assets and things like that. So any of these, what we'd otherwise call insider dealing types or self-dealing would actually be what we call it in that scenario. You try to normalize these by taking them out and say, what would be the fair market value of these? Or in the case of discretionary or unnecessary expenses that are incurred, you try to remove those and say, okay, without these, because in theory, if you sell the company, that many of these would go away, for example. So again, you're coming up with a valuation that is that eliminates these related party transactions and eliminates discretionary or unnecessary expenses or costs to the company. And lastly, lots of times you don't have formal financial statements, so you're just depending on the income tax returns as the financial statements. And as we've already discussed, these are going to be extremely divergent from the actual performance or realities of the company. So that being said, if you recognize all of these things, then you can take steps to actually normalize or make accounting adjustments to reconcile the difference between a valuation method used and your book or accounting or tax method of reporting that otherwise you create as part of the operational process.